Okay, now the recording sales transaction actually just recently changed. Well, it's about to change. GAAP changed the regulations on how to do this, or kind of changed the rules a little bit. So if you have had accounting before, like in high school or something, or if you have an old book, this will no longer match, and it's actually pretty different. The uh, uh, the regulation, the change actually goes into effect, I think, December 15th, but I guess he decided to go ahead and put that in the book. So let me show you how we're doing this now. Sales are, so merchandise inventory, or the purchasing, everything goes to merchandise inventory, and there's just one transaction. When I record a sale, there's always two parts. So if I made a cash sale, for example, I need to record two things. The first is I need to record the revenue coming in. So I would debit cash and I would credit sales revenue. So it's not service revenue anymore, it's sales revenue. Oops, sorry, hold on. Okay. I just need to install that update so that stops coming up. And so I'll debit cash, I'll credit sales revenue, and this will be for, the amount will be what I charged my customer. But then the second thing I need to record, so I've recorded the cash coming in and the revenue that I earned, but the merchandise has gone out and it's no longer here, so I need to record that. So I debit cost of goods sold and I credit merchandise inventory. Cost of goods sold is an expense. Merchandise inventory is an asset, so crediting it will bring it down because I don't have it anymore. So let's pretend we're doing the sale over here. So I charged the customer $1,000 for this merchandise, but I paid something less than $1,000 for it, right? I bought it at one price and then I mark it up and sell it. So this the second transaction that goes in here is going to be what I paid for it. So whatever I put it into inventory for, that's what it needs to come out. So this is what I paid for it. So let's say I paid $700 for this merchandise. And so the $300 difference is my gross profit on this sale. If this was a sale on account, and so sale on account, and I'm going to qualify here this a little bit, no discount offered. Okay, so we don't offer trade discount. Then it would look just like this, except I would be debiting accounts receivable for $1,000, credit sales revenue, $1,000, and then the second transaction would look the same. Debit cost of goods sold, credit merchandise inventory for whatever I paid for it, whatever the cost was to me. Now, the next thing is, let's say I do offer a trade discount, and this is where it's going to get a little bit different. When we were doing the purchases, we could not count the discount until we actually took it. So in both cases, in both the purchases and the sales, I'm sort of taking a worst case scenario, okay? So I can't take the discount as a purchaser unless I'm sure I'm getting it. On the sales discounts, however, what I'm going to do is I'm going to assume that my buyer is going to take the discount. So I'm going to go ahead and take that discount off at the time of the sale so that I am underestimating my revenue, not overestimating it. Because to be honest, so let's say it's a sale on account with discount, and I sold it for $1,000. Let's say the fact is, I know that 90% of my people take the discount, maybe more than that. So it would sort of be misleading to say that I'm expecting to receive $1,000 if I'm pretty darn sure that I'm not going to receive $1,000. So what I need to do is assume at the time. So let's say this was the sale we were looking at with the purchasing, and so it was, the terms were $210, net 30, and this was a $1,000 sale. Okay. So that would mean the $1,000 sale, if they're taking a 2% discount, we have a $20 discount on the sale, right? So so sale on account with discount. So I'll debit accounts receivable, but I'm debiting it for what I really expect to receive, which in this case is $980. That's the $1,000 sale minus the discount. So sale minus discount. And then I credit the revenue for that as well. So sales revenue, 980. And then the second transaction is the same. That's the cost of goods sold, credit to merchandise inventory for the $700 that I paid for it. If the customer then pays me within that discount period, pays within discount period, which means they're getting that $20 discount. I've already adjusted that on here, right? So all I have to do is just like I'm collecting any accounts receivable. I'm going to debit cash. They're paying me $980. I credit accounts receivable, $980, and that's all I need to do. That's what their accounts receivable showed, so that's what I recorded. And so nothing complicated on that one. If, however, if they pay after the discount period, okay, so they don't get the discount, then what I have to do is I'm still going to credit cash. Now this time they didn't take the discount, so they owe me the whole $1,000. So here's the $1,000. I'm still going to credit accounts receivable, but there's only $980 in accounts receivable. So that's all I can take out of accounts receivable. So I've got a $20 difference here, and this goes to an account called sales discounts forfeited, which is a type of revenue. It actually get counted under other revenue with our financial statements. So that's how we do the discount. We record the sale. We take the discount off at the time of the sale, not when they pay it. At time of sale. They pay within the discount, I just record that. If they don't, then I make this, I record the difference here to the sales discounts forfeited. The other thing we have to do is sales returns and allowances. So the same way it would be sort of misleading to report, for instance, on the sale that, or on any sale that I expect to do the full amount if I know they're going to take discounts. The other thing is I know some of this stuff is going to get returned. And so it would also be sort of misleading to say, I expect to receive, $100,000 if I know some of that stuff is going to be returned. So we need to make an adjustment for this too. So the way this is handled now, and again, this is different as of December, but this is how they do it in your book now. So the first thing I do is an adjusting entry to set aside an amount that I expect. Set aside kind of think about like setting aside a little pot of money for estimated returns. So this will be based on your history, whatever. In general, I know that 7% of all sales get returned. Okay, so this is just, you're just going to do an estimate. And so what you're saying is, here's the sales I expect for the year or the quarter or the month. And I know that about 7% of those are going to get returned. I don't know which ones they are yet, so I can't count that. But I know that about 7%, and you would turn that into a dollar amount, is going to get, so here's my expected sales times 7%, whatever. And then I set that aside. So the adjusting entry to do that is I'm going to debit sales revenue, and I'm going to credit an account called refunds payable. Now, I probably mentioned before, you'll only ever credit revenue accounts. You'll never debit a revenue account, and so now I'm a liar because this is exactly what we're doing. Revenue has a credit balance. So if I'm debiting that, I am decreasing that. And so I don't want to overstate my revenue account saying that I'm expecting to receive this if I know some of it's going to get returned. So I decrease that. Refunds payable, because it has payable in the name, it's a liability. So I am increasing that in order to set that money aside. I'm going to owe these people some money back is why it's a payable account. But then I also know that some of that inventory is going to come back in. You know, again, 7% of that inventory that I sold is going to come back in. I just don't know which ones they are yet. So again, I set this aside. I have an account called Estimated Returns Inventory, which is an asset. It's an asset. And so I'm going to increase that balance by debiting it, and then I'm going to credit cost of goods sold. Cost of goods sold is an expense, so by crediting that, I am decreasing it. It's kind of like if we go back here to the sale, I debited cost of goods sold, and I credited merchandise inventory. I'm undoing that, and it's kind of the same thing up here. I'm undoing the first transaction. I am flip-flopping those, except so that's why I'm debiting sales revenue. I can't credit accounts receivable though, because I don't know which accounts they're going to be. So that's why I make this refunds payable. And if we go to the second part of the transaction, I'm undoing this as well. So I'm going to credit that cost of goods sold to undo that since it's a return. But I can't, since I'm doing it ahead of time, I can't debit the merchandise inventory because I don't know which specific inventory items are coming back in. But I do kind of know the amount there. And so these are my estimates. I do this at my adjusting entry time. When somebody actually makes a return then, so this is the adjusting entry, here's the return, I'm going to debit refunds payable. I had this money set aside saying, here's how much money I think I'm going to owe people. Now I'm actually giving somebody their money back, so that's less that I owe in returns. And I will either credit cash or accounts receivable, depending on the sale. And then the second part of the transaction, I will debit merchandise inventory, and I will pull that from this estimated returns that I had kind of set aside in there. So estimated returns inventory. So this would be for the amount I charged the customer. This would be what it cost me. If it's an allowance, so an allowance means, let's say I shipped money to somebody, merchandise. I shipped merchandise to somebody, let's say it's it's a case of eggs, and some of the eggs were damaged. Well, I'm not going to make them send it back to me. I'm just going to say, okay, I'll take that off your bill, essentially. That's what an allowance is. And so all you kind of have to do is the first part of this transaction. So you'll debit that refunds payable, you'll credit their accounts receivable, you'll take it off of their bill, but you don't have to do the second part because you don't have any merchandise back, so you don't have to worry about that. The other part we have is transportation, which again is a little bit different. When we were the buyer, when we're doing the purchase transactions and we're the buyer, everything just went to merchandise inventory. If it's FOB destination, that means that the seller pays the shipping charges or the transportation cost. And right now, that's me. I'm doing sales transactions, so I am the seller. So if I'm responsible to it, that's what we call freight out. Freight in is when you paid to get it here. Freight out is when you're paying to send it to the customer. Again, the transactions we looked at, we were doing perpetual inventory system, so we don't use the freight in account. We just put it to merchandise inventory. There's an appendix in the back of this chapter, and they explain if you're using a periodic inventory system, then you would put it to freight out. But you don't really have to worry about that. We're just going to assume that we're using all perpetual inventory systems. And so if I'm the seller and I'm paying the shipping, I debit delivery expense and I credit cash. And that's all there is to that one. So let's do a couple transactions here. 5.4, journalize the following sales transaction for Salem Sportswear. The company estimates sales returns at the end of the month. So what that means is we can assume they've already put money in that refunds payable account. So on July 1st, let's hope I can fit all these in here. July 1st, Salem sold $20,000 of men's sportswear for cash. Cost of goods sold is $10,000. That's pretty much how you're always seeing it. So you paid $10,000 and you're turning around selling it for $20,000. So I'll debit cash because I got $20,000. And I'll credit sales revenue, $20,000. That's the first part of the transaction. Then the second part is a debit to cost of goods sold and a credit to merchandise inventory for the $10,000 that I paid for it. So every sale needs 2 transactions like that. On the 3rd, I made another sale. I sold $62,000 of women's sportswear on account. Credit terms are 310 net 30. The cost of goods sold is $31,000. So that means I need to take that discount right now, right? So $62,000, and they have a 3% discount. I'm just going to assume they're going to take that. So that makes a discount of $1,860. Oh, what's wrong with this pen? $1,860. So that means instead of recording $62,000, I'm going to subtract off that $1,860. So I'm going to record my sale. I'm going to debit accounts receivable. Assuming they take the discount, they will owe me $60,140, and I will credit sales revenue, $60,140, and then I will debit cost of goods sold, credit merchandise inventory for $31,000. I'm squishing these in here because I'm trying to fit them all on one page. Then on the 5th, they received a $4,500 return on the stuff from July 1st. So that's this cash sale right now. They returned part of that. The cost, to me, the original price that I paid for the stuff that they returned is $22.50. So on 7/5, I need to do a return. So I'm going to debit refunds payable for the sale amount, so that's the $4,500, and I'm going to credit cash. It was a cash sale, so I'm going to give them their cash back for $4,500, and then I have to undo the second part, so I am going to debit merchandise inventory for $22.50, and then I'm going to credit that estimated returns merchandise $22.50. And then on the 10th, I received a payment from the customer on this sale here on the 3rd. They're paying me less the discount, and so they owe me $60.40 since they're taking the discount, and so that's what they pay me. So on 7/10, I just record that I received cash of $60,140, and I credit their I credit their accounts receivable $60,140, and that takes care of all 4 of those transactions. I'm going to do another one here where we look at a couple transactions from both the buyer and the seller's point of view. So if you're doing, so we've got Piranha is the seller, okay? So Piranha is the seller, and they sell 3,500 books on account for $17 each, for a total cost. The cost to me of that merchandise was $35.70, and they're selling them to the textbook store. So that is the buyer in this case. And then the textbook store returned part of it, and okay, and that's it. So we just have to do the sale and the return for these 2 transactions. But we're going to do them both from the textbook store, which is the buyer, and then we're going to see how these same transactions look to Piranha, the seller. Okay. So first, the sale. So on the 10th, they bought a bunch of books, right? So they bought 3,500 books at $17 each. So that's a total of $59,500. So on the 10/10, I'm just going to skip the dates. Well, here, let's try to fit that in. 10/10, they're the purchaser. So this is back to the first thing we did. So I'm just going to debit merchandise inventory for $59,500, and they haven't paid for it yet. So I'm going to credit accounts payable $59,500. That same transaction for the seller is going to be, they're going to debit accounts receivable, but not for the $59,500. We're going to assume, oh no, sorry, we don't have, they don't mention anything about discount. So we don't have to worry about them taking a discount because we don't have that here. So they say, okay, you owe me $59,500, and I credit sales revenue for $59,500. And then they have to do the second part of the transaction. So I debit cost of goods sold, and right here they tell you that was $35,700. And then they need to credit merchandise inventory because they don't have it anymore. So we reduce that asset with the credit. And then a couple days later, 3 days later, on 10/13, they return some of it. So for the buyer, if they return it, they will just debit their accounts payable, and they will credit merchandise inventory for the amount that they returned. And they returned 100 books at $17 each, so $1,700. That same transaction here for the seller. If they have a return, they are going to debit refunds payable for $1,700, and they are going to credit their accounts receivable, showing they're taking that amount off of their bill. And then they need to do the second part, and so that will be a debit to merchandise inventory. They have those books back now. It's part of their inventory again, so we need to debit that asset to increase it. And they said the cost of the stuff that was returned was $1,020. So debit merchandise inventory $1,020, credit that estimated returns merchandise for $1,020. So there's what the exact same transaction looks like from the buyer side and from the seller side for a sale and for a return. Now, I'm adding another problem to this video. It's not in your demo problem sets, but you can certainly go to the study plan and do this one if you want to do it along with it. But I wanted you to see a payment too, how that looked. So this is the same type of thing here. We've got Kane is the seller, and they're selling stuff to Taryn, who is the buyer. And we're going to look at these transactions from both sides. So on November 4th, Kane sold inventory to Taryn, $12,000 on account, terms 310, net 30. The cost of that sold was $4,800. And then Taryn paid the shipping, so it must have been FOB shipping point because the buyer's paying the shipping. And then they paid their bill to Kane. So we'll look at those three transactions here, how they look at for each of them. So the first thing is on 11/4, we have the original sale. So to Taryn, the buyer, he's going to debit merchandise inventory for $12,000, and he's going to credit his accounts payable for $12,000. And that's all. The purchase transactions are actually much simpler. The seller, we know he's going to debit accounts receivable and credit sales revenue, but this one there is a 3% discount, and so they have to assume they're going to take that discount. So if they have $12,000 times 3%, that means the discount's going to be $360. So Kane, the seller, is just going to go ahead and assume right now that Taryn's going to take that discount. So that means I'm not going to say he's going to pay me $12,000. I am estimating that he's going to pay me $11,640, which is the $12,000 sale minus the $360 discount. And that's what I'm going to count as my sales revenue. And then I debit cost of goods sold, credit merchandise inventory. For the cost there, they said was $4,800. So that's what the sale looks like, to the buyer, and that's what that sale looks like to the seller. The second thing they had was on November 5th, Terran wholesalers paid shipping of $30. They're the buyer, so for the shipping, they just put it right to merchandise inventory. If it was the seller and he was paying to send it, then he would count it to delivery expense. But the buyer just puts it on merchandise inventory, and we'll just assume they paid cash for that. The seller doesn't have to do anything with this transaction. And now it's time for Terran to pay their bill to Kane. So this is on the 13th, and so they're within the discount period. So they are going to debit their accounts payable. They need to debit their accounts payable for the $12,000 that's in there, but they are going to credit merchandise inventory for the amount of the discount, which we said is $360, and then the difference is what they're going to pay in cash, which is $11,640. So they don't take the discount until they pay it, but the seller here has already recorded that discount, and we're already showing that they only owe us $11,640. So that same payment over here, they are going to debit cash, and they're going to credit accounts receivable for $11,640, $640. And so what Terran paid is equal to what Kane received. These two cash here match. And so that's some transactions from the buyer side and the seller side. There's a kind of a summary at the end of your chapter. I think it's on page 277 and 278, where it has a bunch of different transactions, and it says, okay, if you're the buyer and it's this is what you debit and this is what you credit. If you're the seller and this happens, this is what you debit and this is what you credit. I think that's a very handy thing to keep around. And then when you're doing the homework, when you're doing the transactions, you just have to make sure you keep straight whether you're the buyer or the seller, and you can go to your little chart and check it out. Okay, I'm going to stop this one, and I'm going to come back and finish with the adjusting and the closing entries, which are not too bad. Most of it's the same as what we did. So let me post this one up, and then I'll be back for the rest of it.